right, lesson 6 is Introduction to Investing. So we're going to be talking about the basics of investing, risk versus return, what to invest in, and how to diversify your portfolio. So what is investing? Investing is allocating money with the expectation of that money generating income or some form of return over a period of time. So, a lot of people think that, investing is only in the stock market or something like that. You could also invest in different assets, like we just said, that are going to generate income over a certain amount of time. So we just talked about starting a small business before, and we brought up the example of investing in maybe a weed whacker or a lawnmower if you're going to start a landscaping business. That is an investment because it will help you generate income over the longer period of time. All right, so what to invest in? There's many different things, starting with stocks, mutual funds, real estate, life insurance, CDs. These are some of our top ways. However, we have found some stats for you to help you decide what you might want to invest in. So, the stock market, the S&P, which is it is a domestic fund, it is yielded 12.86% over the past 10 years. Real estate, so the REIT, which is it is a real estate investment trust. That has an average 1-year return of 10 to 12%. And while you can invest in this specific fund that has to deal exactly with real estate, you can buy a house or a condo or something like that and rent it out, or you could sell it over a period of time, and this will appreciate in value, and it is an investment. The final one is a CD. So this is where you put your money into a CD and you have to let it sit there, and you cannot touch it until that set amount of time is up. And so the national average right now of a 1-year CD rate is 1.88%. So these are just some stats of some different investments. Some of these are secure and the money is definitely safe. Some of these, you could possibly lose your money. Definitely in the stock market, if your pick does not perform the way that, if your pick isn't performing well, you're probably going to lose money. So it's all about what's the right investment for you. But here are just some simple options. All right, so risk versus reward. So this is a common phrase used in investing, and it's really associated with the higher the risk, often the higher yield of returns. So if you're going to invest in something small, like maybe you're going to put a couple dollars into a stock, you're probably not going to make that much money because your risk isn't very high. But if you put a couple $1,000 in a stock, there's a lot more risk at hand, but it will have the opportunity to make a higher return for you. So here's an example question for you. You invest in a startup company with no sales at all, but they have a clear plan on how they will navigate their future. So you're going to give them a large amount of money to start their production. Is this an investment of high risk or a low risk? And I'll give you some time to think about this. Some key terms in here is startup company, no sales, and you're going to give them a large amount of money. So what you think of that? You could pause the video if you'd like. The correct answer is this is a high risk investment because there is no, or because you are going to put a large amount of money into it, and there also is no like sales that you could judge anything off of. This is going to be a high risk investment. So I'm not going to say it's a bad decision, but it's something to take into consideration while you're making these investments. All right, now we're going to talk about diversification, and this is spreading investments across different sectors, geographical locations, or assets. And this ultimately is going to reduce susceptibility of a particular market crashing with other investments experiencing little or no effect. So here's a list of, these are just going to be some stock investments, and this is considered a diverse portfolio. So starting off with Apple, which as we probably know is, or as you probably know, is a technology company. Berkshire Hathaway, Alphabet, which is Google, Microsoft, McDonald's, Costco, Coca-Cola, and Verizon. So as you can see, it's a good mix of consumer goods, technology, real estate. So this is what a diverse portfolio would look like. And let's just say consumer goods. So that would be affecting Costco, McDonald's. We'll just say like the food market in general. If that crashes, you still have many other stocks to rely on that will probably be not affected. They might be a little bit affected, but not as bad as those directly involved with the food market. So this is why diversification is important. I might swerve in that corner, whoa, whoa. Hold on tight, 'cause I tweaking it,